What is going on out there, Foundation Capital investors? Jeff Mitt, PV here, the trustees and principals at Foundation Capital. Today, we're just going to take our investors through what we've been up to in Foundation Capital historically and up to currently and future, showing off some of our previous innovation, what we're going to be buying. So stick around in this webinar and we'll show you guys, if you've been investing since day one, what your returns would have looked like, or if you're a future investor, you're going to want to stick around to the end and see what a new investment would look like in our corporation, in Foundation Capital Private Real Estate Trust, which is an apartment building REIT in Southwestern Ontario. And here's a bit of a disclaimer. So we're going to be covering executive summary, 2025 acquisitions, targeted properties, portfolio overview. That'll be a good one. Historical performance and your opportunity, the leadership. Stick around for that one. And then investment terms as well.
Okay, awesome. So just the highlight for all those who are existing investors, you guys already know our strategy is that we acquire, operate, and improve real estate assets, primarily multifamily apartment buildings in secondary markets. You guys probably know that we are in London, St. Thomas, Chatham, Ingersoll, and the surrounding area. Management team is made up of us, the three trustees, along with our staff. Thus far, from a historical perspective, including our own portfolio and the fund, we've acquired over 20 properties since inception and managed over 60 million in assets, returns of over 30% a year on that entire portfolio.
All right, so guys, one of the properties we acquired this year was 9 Sarah, which is a 2-story building with approximately 12 units. Amenities included in this one were parking, laundry, facilities in each renovated unit. Again, one of the Foundation Capital staples is we take these rundown, beat up units and we go and try to make them look like Toronto style condos. So always adding in-suite laundry, nicer kitchens, lightings, things like that to bump them up to charge a much higher rent, which in turn improves the value of the building. And that's exactly what we did here. The nice thing about this property, it's located less than 2 kilometers away from Chatham's downtown core, close to shoppings, restaurants, other amenities. And as such, we're able to get a diverse range of tenants in a property like this as we manage it and continue to operate it. And the next one,
it's actually super close to the college as well too. It's just a stone's throw away from there. St. Clair College.
Nice. And you guys, what were we like, as we have this asset now in the portfolio, what are some things that we've been thinking of doing to the property?
Yeah. So instead of just adding a vending machine at the end of the hallway to increase the net asset value, we're looking at, you can see that building there. It's pretty big and you see where the windows are and the balconies a little bit. If you do street view, maybe we'll give you a better view there. But in this city, Chatham, the properties are massive. The square footage of an actual 2-bedroom or a 1-bedroom is way bigger than some of the London 1-bedrooms and 2-bedrooms. So if you've been noticing on Instagram, we've been going down there a lot more and showing and viewing it. And when you go down there and you feel it and the rents, the market rents, you're just looking at it and you're like, this is just too big for what it is. Even though it's a 2-bedroom, it's just a massive 2-bedroom. So we're looking at ways, talking with the cities to say, okay, what if we could chop up these 2 bedrooms and make them 2 different apartments within the same square footage? So we're not going to add an extension to this building anywhere, but we're going to look to add another door in the hallway that goes to another part of a unit. So the square footage might get cut in half, but we're still going to come out net ahead in rent. So for example, we might be able to do 2 bachelors within the same square footage as 1 2-bedroom, and a 2-bedroom would get us around $1,600, $1,700, $1,800 in rent, where 2 bachelors would be around $1,200, $1,250 each in rent. And bonus, the government will also pay for to place tenants at that dollar range as well too. So we might even get government-backed rent, or it's just way more affordable for a Canadian to have a small bachelor, flat screen TV on the wall. They can cook. They got in-suite laundry. They can grab an Uber. They can go where they need to go. They're close to school. So we're really looking at ways across the entire portfolio. So just because a property moved into Foundation Capital's trust doesn't mean it's done. We're just going to wait for turnovers. No, the 3 trustees here, we are actively pushing turnovers and then finding out ways, okay, cool, we can renovate this. But what if we chop this into 2 units, increase the value? Because apartment buildings only operate on money in and then the money out. So how high the rent can be and the lower expenses. That's the game that we are working on. And then in the future, so for some future direct to REIT purchases, we will look to acquire properties that we can do this right off the hop.
Yeah. So I think one of the things here, I guess we got a question from Hussein, is how much did we acquire it for, and what's the expected rent? We acquired this building, I believe, for $2,430,000, I believe, is what it went into the REIT at. And some of the items that we've already identified within this existing property, from just converting existing laundry and some of the storage rooms, we could probably get 2 to 3 more units into the building. So again, that would make it into a 15-unit building for just a marginal cost increase. And I guess some of the other items that we'll cover throughout this presentation as well is some of the other strategies that we have to increase the unit count within the portfolio as well.
Good. So then the other one we acquired this year was 100 King Edward. Again, another 2-story walk-up with 12 units in total. This one is in London, Ontario, with easy access to London's downtown, Western University, and a lot of major amenities across Dundas Street there. It's positioned in a really prime location with excellent transit links and proximity to the Highway 401. So this one is another one that's ideal for tenants seeking a blend of urban accessibility and just good residential location. Similarly, as Jeff mentioned, we do have plans to potentially chop up the units in here, significantly improve that NOI, which is then going to significantly improve the value of the building.
And I think adding to where Jeff was outlining that you're getting $1,200, $1,250 in rents in some of these smaller bachelors, we're noticing that both from commentary in Facebook groups, Kijijis, feedback we're hearing from tenants that are calling, realtors that we're chatting with. I think, guys, we've seen even this weekend, what are we seeing in the chats from the different realtors? Hey, do you have any 1-beds available? Do you have any of these? Because we've got quite a bit of 2-beds right now that have come vacant. Which is interesting because from one perspective, we want to rent them out. From another perspective, we're like, oh, this might be a great time for us to split these units. So it's, I guess, reinforcing what we've already been thinking as well, with people wanting those 1-beds bachelors.
Mm-hmm. Another way, I guess, to look at it is like the rent per square foot on a bachelor is higher than than on the 2-beds. So that's another way to kind of digest it too, if for people that are unfamiliar.
Yeah, it's just based on what a Canadian earns, and then they use 30% of that for their rent, and that's just kind of that sweet spot there. That $1,000 to $1,500 is kind of what all they can afford, unless they start putting multiple bodies in there to afford the 2-bedroom rent. And once you get into 3-bedroom rent, you're almost looking to go rent a house. Yeah. So it's just not. So Foundation Capital is identifying that, and Mitt was just kind of chatting, saying the things we're looking at. But you got to remember, we also we had this portfolio during the pandemic, and we looked to do furnished rentals because that's what the market was telling us. Now we're listening, and the market's telling us to do more studio type apartments. So it's just a constant movement that you have to always be listening. The only constant is change in this business, and you got to always kind of be listening to the market and adapting. And that's the difference between us and different REITs, where they're just probably doing the same thing. We're like boots on the ground, learning what the actual tenants are up to and renovating to that specifically.
Yeah, because effectively, like, our tenants are your customers, so you're making a product that they effectively want, right?
Mm-hmm. So
I guess Eric had a question here. It looks like King Edward Ave has 7 identical buildings next door.
Yeah, we try to buy them.
I think, Eric, one of the things I guess we'll highlight in as we go through this is that whenever we are looking at acquisitions for the REIT, there's obviously a combination or range of prices that it can go for. There's obviously, I guess, as his name asked over here, what's the kind of the price that you acquire it for? And he's obviously looking at price per door. What are you paying for a price per unit? The reality of it is if your building has historically lower paying tenants, you haven't bumped the rents, and you're going to the market for sale, that building will get valued on net operating income. And typically when it's operating on net operating income, it won't even qualify for, sometimes $100,000 a unit or $125,000 a unit. And a lot of the financing that we get is through CMHC. And again, that depends on how much income the building is generating. So we look at a lot of stuff that already has a bit of turnover. So usually the buildings that we want to acquire are not 100% not renovated. We want about 50% renovated, and then we can go get the remaining uplift in the portfolio. And the reason why that's important for us is that we're able to then buy the property as is. It's able to service its debt, pay the cash flow yield to our investors of that 7% or get close to it, while we then turn over the other units and continue to push the appreciation and cash flow up within the portfolio. If we were to go out and buy, let's call it a couple of these King Edwards that are all low rents and paying a price that honestly is probably overvalued, you're not going to see that uplift until you get to that 50% turnover mark. So all of that cost gets eaten up. And if you're aware of what's going on in the market, right now there's a bunch of inventory available. So we're taking our time to evaluate the different opportunities, make sure the things that we're buying are going to kind of immediately provide value to our unit holders, and then allow us to continue to extract value. And so that leads us to our target properties. These are ones that we've already signed the APSs. It's just a matter of waiting for CMHC to close them. And with that, I'll hand it back to PV.
Yeah, our target property one is 222 St. Clair, which is a 2-story building with 22 units. It consists of 20 residential units and 2 commercial units. Again, this one is in a very good location in Chatham, surrounded by schools, shops, and minutes to downtown. Highway access is also very close in proximity with the 5 to 10 minute drive. And again, the most important thing is we have the option to improve the net operating income again to generate a return for investors. Combination of getting unit turnovers as well as splitting the units and improving income that way.
This is just such a massive property. And just from the past slides, seeing what we're doing with some existing and what we're going to do with targeted now, you guys can see where there's just way too much square footage here. Like if you can see that A down there, then the B, then C, there's even more past A, and then C goes back. Yeah, all of a sudden we're like looking at everything and we're like, oh my goodness, we can make so much more apartments here. So as vacancies happen, instead of quickly just putting down the millennial gray floors and painting, we're like, all right, well, maybe we can do 2 units within the same square footage. I got tons of Instagram out here on this. There's old videos. You can go through this. You just see our thought process over the years at knowing this property. So and as we renovate this, when it's in the REIT owners are going to benefit from this as well too, as we boost the income. So I can't wait for you guys to get this one into the REIT. And then in 2026, when we start some major renovations on it, you guys are all going to get the bump of this building. So that one's going to be a good one for you guys. Look at that square footage too. It was like insane, like 35,000. Yeah.
Positive.
Okay.
And this one's pretty big too.
Is Vanier, which is a 3-story building in 21 units. Again, good location in Chatham, not as massive as the other one, but again, in terms of us being able to lift the value and have it generate strong cash flow, that potential's there. So another exciting property that we're planning on acquiring this year. So these, when we say target property, these are already under contract and, we'll be closing later in the year. But, again, with Foundation Cap, we have a lot of other exciting potential acquisitions lined up that we're working on. It's a matter of not only getting those deals under contract, but then raising the capital from investors like yourself in order to take that step, close it, and then we can get to work improving the value and generating the return.
And so so far you've seen what we've acquired in 2025. You've seen what we're going to be acquiring, and now revisiting what we've already acquired so far and what's in the portfolio. And when you're seeing those returns, when we're getting the year-end audits done and the performance of the properties, it's based on some of these other assets that we already own as well.
This is a 6-plex in London, Ontario. It's on the same lot as property number 2, which is an 11-plex. They kind of like look at each other. This was one of our first acquisitions, and we pretty much have every unit renovated in there. I think we're just missing one or two. So pretty much maximize the value there. But wait, there's always more in Jeff Weibel's tricks. So there's a couple more things we can do there that we're looking to renovate the locker room and turn that into a unit. So it's 11 plex right now. That could become a 12 plex very shortly. So we're working with City on that. And there might be even another surprise there, but maybe we'll save that to the end for these two properties. And then this is in Ingersoll, Ontario. And this was quite the war zone when we first bought it. And then it got into the REIT as it was making money. But you can see, I can't see the before, but you can see the front. We got the classic weed shop in Ontario as a tenant. So the bottom three are commercial tenants, and above there's 18 apartments, all kind of small bachelors and one beds. And that's kind of where I got the thinking on a lot of the other portfolio, because all those rent for 1,200s and 1,300s. It just blows your mind to think but that's just like the baseline in Ontario, and you just renovate them nicely. Even though they're small, you put in sweet laundry, they rent. So we got pretty much the whole top renovated there as well in Ingersoll. You guys can drive by. It's right on Thames Street. If you're a REIT owner, that's part your building. So you can go buy your weed there if you want. And then, although it doesn't go to us, it goes to the tenant. We help the tenant out. And then this is back into Chatham. This one is very unique, very awesome building. When you think about real estate investing, you want to buy what PV was talking about earlier, close to the downtowns and all this stuff. This one is like literally stone's throw from the Chatham Hospital. And all the units are, again, massive and very well renovated. So this is such an easy building to rent. It's 13 units in Chatham. It's in the REIT already. Every time we get a turnover there, pretty much just put the ad up and we get it rented right away.
It's tough on this one because obviously we want to do our operation, chop it up a bit more.
So
but
nice.
the problem is it's like in so high demand, it's always typically rented that we can't. By the time we're like, let's execute on it, let's get the architect and planner on it.
We could do. So it's just something we could do in the future, because that top half there, it actually, if you can kind of see, there's that walking balcony above the lower windows. Mitt's kind of going there with the thing. We could, the top half is, they have the ground, the middle part, and then they get the upper part, and then the bottom floor is just like one floor kind of apartments. But that upper part, we could figure out a way to split those as well too. And so that somebody gets like the middle and then another person gets the top. So they have like 2-floor apartments there, and yeah, they rent super fast, doctors, nurses, etc., because it's literally right there. Back to London, Ontario, we picked up 57 Oliver Street, and we've been slowly turning over all the units, just doing the normal, get a low rent up to market value. And then again, there was a unit the bottom right unit there. If you're staring at the front door, the bottom right, that one became vacant and it backed onto like the maintenance room. So then we get our real estate investing hats on, and we're like, well, what if we turn the maintenance room into a unit and stole a bit of the square footage of this room? So all of a sudden we're dealing with that, and now we're talking to the city of what else can we do with Oliver. So again, you're not just making extra money from a vending machine. We're looking to ways to like massively increase rent within the same building that we already own in the REIT. So again, investors will benefit in 2026. We're going to have a really, really busy 2026. So get your investments in. Maybe that sounded salesy, probably, but if you don't, we can't do a lot of these rentals as well.
If you're wondering, this is the video that we had showcasing it. So make sure you go to YouTube. You can watch the whole video in action, and you can see what we're looking at.
Well, you can literally go watch this video, and me and Mitt's heads were like spinning, and we're like, oh yeah, we could do this, and we're down in that bottom unit. So I think one of the differences too in our private trusts, we're always constantly showing things on social media and very well connected with even some of the investors here in the chat. You guys know that we're living and breathing this daily so that you guys can get your returns.
So then his name asks, what mortgage terms do you guys usually get for the properties, and are any of the properties coming due? So I think that brings us to basically our next slide that we actually had coming up. So I was waiting to answer that one.
I was take it away.
As you'll see with our properties, most of the debt is coming due in 2034 and onwards. We are obtaining CMHC financing on our properties, and we're typically looking for the 10-year amortization. obviously there's considerations of whether you want to do a 5-year or a 10-year. The reason why we always go towards the 10-year mark is that we're typically buying it already stabilized a bit, and the handful of turnovers will probably just go get a pari passu second to pull cash out if we need to. I think, PV, do you want to cover what the sort of LTV on our portfolio is?
Yeah, so as a whole, our LTV for the portfolio is about 65% LTV. So, we make sure that we monitor that number very closely and we're not in an over leveraged position. As you can see, that's based on this 14.5 outstanding debt amount versus the total valuation of the properties.
And I think one thing that I guess people always wonder is like, oh, well, you have in your deck, the portfolio can go up to 75%. You can go 85, 90 on a single asset. And really for us, it just depends. Like if there's enough opportunity for us, we'll go and look to refinance and pull out capital out of some of these properties. But for the most part, otherwise we'll let it kind of run. And that's how we determine the valuation of some of these properties. So if you're ever wondering what it looks like for the portfolio, as we do these roundtables on a quarterly update, you'll get to see this as well. And all of it, again, is with CMHC financed debt, so it's low interest rates. There's nothing private financed in this.
That's definitely some of the questions we get on calls all the time too. Target markets are for acquired properties. Guys, we buy pretty much Southwestern Ontario. It's what I always say on the calls or on Instagram, YouTube. The 401, I think everybody relatively on this stream will understand where it is, but it flows out of Toronto down to Windsor. That's the corridor for the most part, the Foundation Capital purchases. You're not going to see Foundation Capital buying in Owen Sound. You're not going to see us buying in Saskatchewan. You're not going to see us buying in Ohio or to any American city or whatever the flavor of the month is. We only buy in the 401. Why is that? Because the strong economic fundamentals of Toronto, I said that like an American, Toronto, where the jobs are, where all the government puts the money in is Toronto, and purchase prices are insane in Toronto, but rent is actually pretty standard going all the way down the 401. So we buy almost half price and we have all the upside still getting this almost the same rent as it is in Toronto, where they're struggling to rent their condos down there. It's just, it's a primary market. We're not going to buy in just some tertiary market where they're going to lose their jobs, because you want to buy where a tenant can actually go to work and pay you rent. And London, Ontario is not going anywhere. Chatham's not going anywhere. It's right on the highway. This is where the goods flow down. So anyways, that's where we target. We will look. We added in Woodstock and Kitchener. We don't own anything there, but we're always looking. So, and the KWC in general, Kitchener, Waterloo, and Cambridge. So
yeah. And if you guys are on our newsletter, you will see like kind of the analysis that we go into. We do look at the jobs kind of in the area. And it's interesting, right? Like in Toronto and the GTA, there's a lot of competition. There's a lot of people. People are trying to get $17, $18 jobs, and it's very difficult. Whereas in the markets that we focus on, you can go and find a blue-collar job that pays you anywhere between $20 to $25 an hour. So that's kind of what drives us and makes us say, hey, you know what? We can fundamentally, even if somebody loses their job, they can find another one where they can afford the rents that we offer.
So historically, when we first launched the fund, the value for one unit was at $10 per unit. After our first year, that was bumped up to $11.50 a unit based on a 15% appreciation target. So again, we target at least 8% in appreciation, and in that year we were able to do 15%. If you add that with the 7% cash flow distribution, we delivered 22% for that year. And then for as of May 30th, again, we were able to achieve 8% in appreciation, meet our 15% target. And just recently, based on our latest revaluation, we were able to bump the unit the unit price by 2% to $12.65. But keep in mind, that was for a quarter's worth of activity.
Yeah, so I think one of the things is that when we first launched the REIT and we didn't really have as many properties in them, it made sense for us to do the valuations annually at the time. Now, as we have more units and more properties, we're getting to do that internal valuation based on the units that we're turning over And again, we're touching base with our appraisers. We obviously know the methodology that they utilize to appraise it. We're looking at recently solds, along with what other places are renting for, and then comparing our rent roll and expenses towards that. And then based on that is how how we're confidently able to ensure that we are driving this value. And so I think a big piece is all of this isn't like we don't hope and pray. We know what the performance is. We know where the performance is going to be, and we know that for like if we spend X number of dollars on a renovation, we will get this rent, and this rent will translate to X dollar value in return for our investors. And so, doing that calculated approach again is how we are pushing this net asset value price up.
So, example of if you had invested 100,000 with us at launch, and how that would have played out as of today's current date. So, if you had invested $100,000 into the fund as of inception, you would have made a 52% return, and your investment would be sitting at 152,000. That's about a 19.6% net IRR, I think, based on an annual basis. That in period from inception is March 15th, 2023 to October 31st, 2025. So just a bit under 3 years. I'm sure you guys can tell, just given the other opportunities in the marketplace, this is a very steady, strong return, especially for something that is as stable as real estate, and you don't have the volatility that you get in some of these other riskier investments. So you're getting the best of both worlds, stability, but also a strong return at the same time. Another thing I wanted to highlight on that slide is, again, if you elect for the DRIP program, your investment could be even higher because your monthly cash flow is being reinvested and buying shares at a 2% discount. So you're automatically making an extra 2% by electing for DRIP, and then that's compounded and grows as well.
And when you look at it from like a 1 year point, it doesn't really mean a lot, but once you start stacking it over a number of years and your investment is compounding, it adds up and becomes seriously meaningful. So,
sure. And I think a thing to always remind yourself is real estate is a long-term game. So the longer you hold these investments and you give it its time to do its thing, again, not only are you getting strong, stable growth, but in the long run, that number can really compound and grow.
All right. So with that, we've covered kind of what we've acquired so far, what we're looking to acquire. You've been hearing a little bit about what we've been doing from the standpoint of intensifying within the portfolio. You've got to see all our historical performance. Now let's talk about the opportunity that we're seeing in the market and what like 2026 looks like for us. So as you know, throughout this time period, we've just been executing on basically our value add BRRRR strategy, which is where we're buying these properties in locations and setups that we think are allowed to be very quality, as in they're good locations, they're built strongly, there isn't crazy structural issues that we can't fix, or we're getting them at decent prices, and there's a lot of repositioning potential. Predominantly, we look at stuff that again has been half kind of turned over, and we get to do the remaining bits of turnover. But it doesn't mean we won't look at some of these heavier lift kind of renovations as well. Again, it depends on our portfolio, and we've been doing that, again, taking what looks like older places from the 1970s, putting in those nice finishes, making it look like a brand new Toronto condo, and then renting it out at the market rents. And then we're refinancing with CMHC. So far, we're just predominantly in this portfolio in the buy, renovate, and rent stage. We've yet to refinance, but we do finance everything through CMHC. So it isn't like we're sitting in high interest rate debt with the private lender. However, if we do see like crazy opportunities, like right now, I would say we are seeing a lot of opportunities coming across our desk where there's investors who've owned properties now for a decade. Some of them bought it in only 2022, but usually the guys who've held it for over a decade plus will look at trying to offload their assets right now. The problem is the sales that are happening in the market are a bit much lower. But again, those ones usually have much lower rent. So we have to do an analysis of balance on our side where we have X number of units rented at X high rents, X number of units at low rents. Well, if we buy an entire building of low rents, what is that impact? And right now, that might not make sense for us, but we're looking at creative things where maybe the seller might be able to give us a vendor take back mortgage in second position. So the REIT's putting in less capital. So the cash tied up in the deal is less, which means even though it's performing as a lower return, it's producing higher on a lower capital investment. So we're looking at strategic things like that. But outside of that, what we're also looking at is how can we squeeze out more dollars as the market kind of stays stagnant? Because again, there's a floor price as it relates to the purchase price on these properties on a price per unit. So what we're doing is we're trying to add the next layer of value to our strategy. So instead of just updating the older units, make them look nice and rent them out, as Jeff talked about, we're converting some of the underutilized common areas, whether it's laundry rooms. Again, when we're buying a building, we're shutting down the laundry rooms. We're putting an in-suite laundry into our renovated units. We're converting storage rooms, maintenance rooms into part of units. So we'll take a 2-bedroom plus a part of a maintenance room or storage room and make that into 2 separate units, forcing that rent to go up. Again, we covered turning the larger 2 to 3 beds into multiple smaller units. And again, we are focused on creating that new supply of clean, modern units at the $1,200 to $1,500 mark. And we're leveraging different community improvement programs by the different municipalities. So if you are in London, Ontario, and you are focused on a area which is considered a transit corridor where the rapid bus transit's going in, there's transit grants available for additional units that you create there. If you do affordable housing, there's also affordable housing unit grants that are available. What we're looking at is doing a mix of, hey, we want predominantly market rents, but if we can squeeze affordable and we can stack dollars so we're not tying up as much of our own capital or the REIT's capital into doing the reno, then it's really a levered return for the REIT. And we're layering that in to basically juice the return. So you're going to burr it and basically leverage government grants and opportunities to create more units. And why this works now is that we are seeing a massive shortage in basically workforce, lower middle income housing at that $1,200 to $1,500 sweet spot. We've said it multiple times in our newsletters. You've probably seen us say this in multiple of our YouTube videos. All the new builds that you're seeing come to market are all at $1,800 plus for 1 bedrooms. You're looking at 2 bedrooms at $2,000 plus. And sometimes people are asking themselves, like, man, maybe I should just buy a condo, buy a house. Like, it doesn't make sense. Like, when you're trying to rent a 2-bedroom out that's brand new in London for $2,300-$2,400, you got to ask yourself, well, why don't I just go buy that older home for $400,000-$500,000 and make a similar mortgage payment? And that's what people are doing. Versus,
and you'll see on Twitter people saying, oh, rents are coming down in Ontario. Well, yeah, they're coming down from these luxury units that people have made. And that's why they're coming down, because they're no longer, Canadians can't afford those.
100%. I think they were, one of the reports was like, oh yeah, London 1-bedrooms are coming down from 1780 to 1686. And I'm like, well, our rents are at 16 to 1650 for 1 bed. So yep, we're fine.
Yep.
And I think it also goes back to what PV was saying, right? We're basically driving, we're not necessarily looking at per se, let's call it total dollar rent per unit. Are we getting a higher rent per square foot? You know, you're splitting the units, so you have more units and we're getting more dollars per square foot. So that's another way that we're driving the ROI outside of just updating it and getting higher rents. Again, the intensification of making additional units costs basically half or less than half of building a new unit from the ground up. So splitting it is obviously what makes most sense. Mm-hmm. And again, these additional units you're able to add, anywhere between 15 to 40% of additional units or even more into the total number of units available. But it has only a marginal impact because, again, you already own the land. You're not buying additional land in order to build these units. You're using the existing land. You're using the existing footprint. Even on areas where we're looking at, okay, do we add another layer above? It's still cheaper than going out and buying a parcel of land and going through the rezoning, site plan approval, and getting it done. So by doing this on existing multifamily is how we're forcing those returns. And again, it complements our existing strategy of buying existing and refurbing it as well. And so, as you guys know, if you want to get involved, we do have an open-ended trust. You can invest at any time. We offer a 12 to 15% targeted return, 7% distribution, which we've done historically and continue to do. And we target about 5 to 8% appreciation, as PB covered. We did 15% and 8% last year in appreciation for a total of 22 and 15%. And again, that IRR was at 19.6. Across our portfolio, we're looking at about 75% leverage, and we will look to do 85 to 90% on any single asset. Again, these returns are net of fees, okay? So it's not like you're making this and then we're charging you fees and taking money out of your pocket. That's after all the fees is what you're getting in your pocket. And if you are using a financial advisor to invest and they are using a fund management code, we do have fund management code through FundServe where our code is RBS 3300. If you're not all fancy and you don't have a financial advisor doing all that stuff for you, charging you management fees to do that on your behalf, you can do this all yourself, super easy. You have to use our exempt market dealer, Equivesto. Just honestly, you have to create a profile. They're going to vet you to see if you're a retail eligible or accredited investor. Retail investors can invest a minimum or maximum of $10,000 a year. That usually means you are worth less than, or you make less than $75,000 a year individually, or you don't have a certain number of assets. An eligible investor is anyone who makes over $75,000 individually or over $125,000 together with a spouse. And then for accredited investors, that means you make $200,000 a year individually or over $300,000 with a spouse, or you have a certain number of net worth. If you have questions, you don't know what type of investor you are, you don't know what you're doing, book a discovery call, scan that, book a call with us. We're more than happy to help. Again, as you're seeing, our stuff's not sexy. We're not like, building rocket ships to space and
come on,
or building AI products. We are utilizing AI within our business. It's just AI advantage to our business, but we are just doing boring old real estate, giving people the housing that they need. So if you want to get involved, go to the offering page, scan it, create a profile, get signed up, get your investments in. I'm sure you saw that we did a price bump in September 30th, and the price went to $12.65. We've got another one for the end of December. So likely with Christmas and the holidays, it's going to tie up. So get your investments in within the next 2-3 weeks so you can get in before that price bump.
We got to show this a little bit here. So that's pretty awesome. So appreciate that. We definitely love hearing the transparency word, and that's on our minds daily of what we try to do at Foundation Capital for years, not just one day, but like we're always showing what we got, showing our renovations, showing you guys the returns, showing you guys the work, giving you guys the swag.
Yeah. So, I think obviously, guys, there's been a lot of exciting stuff that we've been seeing. At times, it's been pretty slow for us, right? In the sense that we're constantly turning over what we can within the portfolio. We're seeing a bunch of these deals come across our table. And I think our biggest limitation and hurdle right now has been just getting the capital in, right? The capital to take on some of these additional properties on the fund side. I think we've clearly proven that we know the strategy, whether it's just burning the property as is, and whether we're going to do some of this intensification as well. I think that's what 2026 is going to be exciting, is the investors getting follow along for some of these massive turnovers on these buildings that we're going to do, where unit counts are going to go up 20, 30, 40% within some of these buildings.
Like you said, Mitt, in the opportunity section, I think we have a very exciting opportunity right now. It's given not only that we have the expertise to execute on a strategy that works really well, we're also seeing a lot of deals available in the marketplace right now versus, a couple of years back when the market was really hot and everybody was thinking that they could do real estate and things were getting out of control. It was tough to get good deals and execute on them. I think right now is a period where we can do so. And, the missing piece is the capital. If we can get the capital in there, the growth can be exponential over the next few years. So I think there's a big stress on the urgency there for the opportunity that's available.
100%. And I think one of the great factors has been, like, obviously we're talking with the municipalities and they're telling us that our additional units that we're looking to create will actually qualify for some of the grants and loan programs that they have. So it's going to really allow us to juice that return. And again, those programs are limited with the government. So we're trying to get in and get qualified for them now, buy more buildings and get those approved for those grants and stuff as well. Because again, that provides us with that levered return. So if a reno is going to cost us, call it 50, 60K a unit to do that conversion, when the government's giving us anywhere between $15,000 to $60,000 to do that, hey, if you're getting an additional unit for effectively free, then why not, right?
There's like 8 million raised so far, and we're open-ended.
Since you're here, you can see, okay, this is just my mock account, whatever. It's not up to date for a thing, but what you'll see going forward is you will be getting your investor portal access, which will show all your accounts with your transaction history. You'll be able to go into that. You'll be able to see your activity here, export your statements, get updates from us, see any other documents, and all that jazz. So that's something that's exciting that you're going to be able to look forward to. This is a long time in the making. We're just in the process of getting the remaining investors uploaded into the system, cross-checking so that there's no issues, so that, you know, when you go to blame the coder and the developer, you're blaming me. So I'm working on it. So please work with us so we can get this. There's obviously paid solutions that we looked at. Unfortunately, the market does not do monthly distributions. They want to provide you quarterly updates, or they want to charge us like $500 like an investor statement, or $100-something investor statement, or and $500 a quarter for some of these updates. And that was an add up to like tens and thousands of hundreds of thousands of dollars to do investor reporting on our scale, that we said, you know what, that makes absolutely no sense. We'll just spend our time instead and make it happen. So, so we're at. So if you, again, I guess we had Sultana there ask, Tatiana or Sultana? Or
Tanya.
She can get
the discovery.
Okay.
Copy this. I don't know if you can click that, or you just have to like put it in your browsers, but you can also just use your phone and go right there. And then, yeah, we got to time this, you know. We're at like $9.99. Somebody's gonna have to come in with like $7,007.
There you go. And I think, yeah,
that's all you, Alan.
And then, did you already highlight Andy's comment when, I guess?
Oh yeah, sorry, yeah. Yeah, why don't you talk about the physical way that this actually happens? It's kind of like a 2FA between all of us, that we have to release the funds on these days, right? Like there's a lot of behind the scenes work you guys don't really see.
Yeah, so like we obviously like calculate out what your distributions are, and then we review line by line the distributions for people who are receiving cash. And then if you're a cash investor, we ensure your bank information is all correct. Then we put the distribution out for each person. We cross review between, what our internal investor register looks like, what the statement's looking like versus what's in RBC. After we do that cross check, we set it up and send out the payment, or approve, set up the payment, and then Jeff and PV review and release. And then RBC and the banks do their thing. They go, we're archaic. And then 6 hours later, they'll put the money into your account.
Say check tonight.
So crypto, if you had crypto, you'd have it right away. But that's why there's that push and pull and delay. So if you guys have any questions, concerns, or anything, give us a shout. Find us on equivesto. Find us through the discovery call. Otherwise, you can find us on social media, wherever.
Social media, newsletters, emails. investor.relations@foundationcapital.ca.
We will, yes. So Eric is like, see you in the next 2 months on the next webinar. Eric, you got to make it out to our investors.
Well, yeah, we'll have a social, usually London in February, and then GTA in like April, right?
Yeah.
Something like that, yeah. Mm-hmm. I mean, you guys let us know. Do you want to see us sooner in person? Other things, let me know. We'll go from there.
Foundation Capital,
and I think
soccer game.
Their webinar before then, so
we'll do webinars.
All right, guys. Thanks so much. Enjoy your weekends, and See you next time.